This that
Red Panda Anthem.
Ian, what's up?
This that Red Panda Anthem.
Red Panda, what's good?
So let's get right into it. So how do you feel the investment market holds for Q1 of 2023? Like, what's your outlook for Q1 of 2023?
Time of opportunity. I just heard the Einstein of Wall Street on, and I agree with his concept, but if I think back, I mean, history repeats itself constantly. So if you go back to between 1978 and 1981, the Federal Reserve raised the interest rates from 6% to 18%.
Jesus.
And the market kept functioning until it didn't, because people didn't catch the interest rates. The economy didn't adjust to the interest rates. But then the interest rates started going back down. And by 1987, I bought my first house, and I paid $925,000 for it. And I got a mortgage on it from Citibank that was indexed with LIBOR, and the rate was 9.25%. Wow. So I was able to buy a house, pay 9.25%, and feel good about it. So what will happen is that interest rates were just way too low. So for example, that house, if I were buying it 2 years ago, if I had the same money that I was paying on debt service, which in that instance was almost $100,000 a year, that would have bought me a $5 million mortgage. So the question we have to ask ourselves is, how much does real estate appreciate, and how much does it fluctuate based on interest rates? And interest rates have a lot to do with home values, because people borrow money to buy their homes, and real estate overall is a leveraged business. And so interest rates affect valuation very quickly.
I see Troy over there. I know that look.
No, you got it.
You sure?
Yeah, go ahead. We'll flow like this.
I want to ask a question that everyone in the audience wants to know. Let's say we're starting from scratch, and let's just say I was your best friend. How do we get rich in real estate from 2023 to 2025? Is that what you guys want to know?
Please.
How do we get rich in real estate, brother?
Well, look, I know a little bit how to do it, because I started off with about $600, and then last count, I mean, you know, I was at close to $1 billion. I think I've done a bit better.
Let's clap that up for him. That's amazing.
Very close. Yeah.
Close to $1 billion.
But right now we have a pipeline and a portfolio of about $10 billion of real estate. And I started off doing, my first building was $10 million. Okay. So real estate's a leveraged business. And so we can't be afraid to borrow. That's the first thing. I mean, I learned a long, long time ago, one of my mentors said that if you owe the bank $50,000, you can't sleep at night. If you owe them $50 million, why should you both be awake? So the idea is to get comfortable borrowing money.
And what interest rate would be great to borrow at?
I mean, it does. I mean, I think it's more about income. Okay. You can look, in the real estate business at the level that we operate in. So, for example, let's make it easy. Let's take a $500 million building. So a $500 million building, we are going to get 60% in debt. Okay, so that's going to be $300 million. And then that other $200 million is equity. And I won't put up all that $200 million. I'll go to Goldman Sachs or, you know, Apollo or one of these private equity funds. And they'll put up 90% of it, and we'll put up 10%. So I'll put up $20 million, they'll put up $180 million. They are going to charge, if we were doing this right now, they would be charging what's called a preferred return of about 14%.
Okay.
And they'd be looking to earn 25% on their money. So it's really not, it's just the interest rate fluctuation just really affects equity to a degree, except when you're buying very tight deals like cap rate deals on apartment buildings. If you're buying at a 4.5% cap rate and interest rates are 6, and that's a tough deal to make because you're not making a spread. But real estate's all about leveraging, and so your cost of capital is, you know, one function of it, but it's also what is the market value of the asset. The challenge with residential real estate on right now for, say, buying homes is people's buying power has been diminished significantly because most Americans buy homes with mortgages. And so their buying power has been cut in half at a minimum, and it's sometimes more. So 6 months ago, 8 months ago, somebody could buy $1 million home if they were making $100,000 a year. Now they got to look at a $500,000 home, and so their mindset's not there. So that would lead somebody like that to rent. And so what happens is when people can't buy, they rent, or they can't buy what they want, they rent. And so the rental market will continue to get stronger as interest rates go up. But what will happen also is how home values will go down. And so right now, we're in a time of this uncertainty. No one kind of knows what's going to happen. But the fundamentals for real estate are very good. Unemployment's very low.
Yes.
Income and salaries are high. Wages are high. There's a backlog in demand for products. So every element of the economy fundamentally is good. So it's just, are people willing to pay what it costs to buy, or will they pay a little bit more to rent and wait until there's another time? So right now, our strategic direction is that we're focused on buying, we're developing rental properties now. We did condos before. Now our real focus is more on rentals, except at the ultra high level, and then people are buying in cash, so they're not interest rate sensitive.
Mm-hmm. So during COVID, there was this mass exodus. Everybody was leaving New York. They said the price is too high, rent's too damn high. I know you have real estate, obviously, developments out in Miami, but the Affirmation Tower is going to be here in New York City, right? We just had a midterm election. Our governor's still in place. I wonder what your thoughts are the future economy of New York and why it's so important that the Affirmation Tower is here.
Well, New York is one of, if not the greatest city in the world. So there's always a demand for New York. And what's happened is there's another generation of people who want to come here. New York got a little bit more affordable. And also, most people in New York rent. 75% of everybody who lives here rents. And so the idea that the condo market has softened up just means that the developers who can't sell those condos will now put them in the rental pool. So New York is getting younger. And I think, look, New York used to be, up until really Bloomberg came in, it was a city about creativity. It was a city about excitement. It was a city of diverse people. It was a city of, different walks of life financially, just a unique melting pot. And then Mike Bloomberg, over 12 years, made it almost a Beverly Hills, and it became a money-centered place, and everything was about money. It was about money. And so property values ran up. Especially Mike Bloomberg's focus was attracting really rich people to come here and buy apartments. Well, they ran up the price. Mm-hmm. And so, but that has nothing to do with the fundamentals of New York. It's such a small market. So New York's not dead. It's strong. We can all see it. All the traffic, we're walking around, going into the stores, you're seeing people shopping, spending money, they're going out to the clubs. Everybody's active here. So New York's going to have another big run. I mean, it's an expensive market to get into. So that makes it a bit more challenging as a real estate investor, especially an early investor. If I were looking to make money today, I'd be looking to go into markets where there was a demand, an unmet demand for apartments, for example, rental housing, or single-family housing, and buying some houses and renting them out. I'd be going to places like Fort Worth, Texas, Dallas, Texas, Nashville.
Nashville.
I think Jacksonville, Tampa, Tucson, Arizona. I mean, places where it's tax-friendly, high quality of life, and more businesses have moved there. One of the things that's going to happen, and is happening now, especially with remote working, is the businesses are relocating out of places like Chicago, out of New York City, out of DC, for example, as well, and out of LA, because taxes are so high.
Yes.
And so they can save a significant amount of taxes. If you're in an environment where the tax rate's 13%, you go down to Miami, you get better weather, and there's zero local income tax or state income tax.
This that
Red Panda Anthem.
Ian, what's up?
This that Red Panda Anthem.
Rap Panda, what's
This
good?
that Red Panda Anthem.
Your
Whole
boy.
clip going up. I know they can't stand it.